The problem is that most of the time, these investments, nobody says like, oh man, these investments, I pretty much had an idea that it's going to be terrible and I was going to lose my money. Most of the time, it's just that the gambling, the bet paid off multiple times in a row. Therefore, there was a false confidence built in the gambling of that investment. So I didn't do due diligence. I didn't do the work. But it turned out fine. And then boom, crash and burn.
Most people believe passive investing means little to no work. But here's the truth. Passive doesn't mean effortless. Many physicians have lost hundreds of thousands of dollars making this mistake. If you think you can throw money into an investment and walk away, you're setting yourself up for failure. The real work is upfront: research, due diligence, and strategy. Today, we're breaking down why passive investing is anything but hands-off. I'm Nate Crannell, joined as always by Mike Neubauer. Together, we've built Grand Vision Family Office, helping physicians break free of living in the rat race before it's too late, so they can live the life that they imagine today, not just after retirement. We are the resource for the physicians who ask themselves this question: why wait for retirement? All right, Mike, passive investing. That means just hand over your money to a deal and sit back and wait, right?
Yeah, of course, man. That's how it works. Super simple. That's the scary thing, is sometimes it does work that way. And that's the dangerous cliff, I guess, that people walk that edge, is when it works, it reinforces a bad behavior. And then all of a sudden it works until it doesn't. And then that's when the huge regret comes. And most people, they put their money into a deal. They don't really understand exactly what they're doing, or they don't have a team behind them to help them understand. And they assume, I can just put this money into the deal. These people are going to take it and run with it, and I'll make passive money. Sometimes that works. Sometimes it doesn't. When it doesn't, it is usually catastrophic. We've talked to a number of people over the last few days, honestly, that have even brought up family and friends that they work with that are physicians, and they've put money into a deal and they've lost, I don't know how true it is, but some said over $1 million, for sure, hundreds of thousands in deals that went bad, and there was just no money left when it came time to pay back investors.
For sure. And I think the common denominator, when it either is a great situation where you place your money and you do sit back and wait, or you place your money and the deal falls through, it all comes down to trust. I think that's the common denominator. Like, you trust someone, you know that their track record, that they can perform the way they say they're going to perform, and that's a great deal. And you just have that trust in that person. Or you have a trust in someone who you believe, based on what they've shown you, is capable of fulfilling this deal, and they just can't. But it's just because you have that trust, whether it's, a brother, a cousin, an uncle, a neighbor down the street that you've known forever, you having that trust can honestly be a detriment sometimes.
Yeah, sometimes. The biggest thing that people run into is their trust is usually not based off of real factors and what it should be. I guess what I'm trying to say is, the mistake that most people make is they base it on the track record of the person and who they're investing. And that's a dangerous slope, because every deal is going to be slightly different. And a track record, it can be great investment time after time, but then something changes. There's a change in the market, change in the economy, change in any circumstances. Maybe this investor has grown and grown and grown, and they're going to take the next big leap, but maybe this is all new for them. So even though their track record was great, maybe this investment is a new area for them. Maybe it's a new type of property for them. And that deal specific means that the track record may not be as powerful as once was thought. And the problem is that, you said trust, I'll call it confidence. The confidence that this deal is going to perform is not based on the metrics of the deal. It's based on the track record that they've had in the past. And this is what I say, it's an investment hack that I tell people in the family office: if you want to invest with somebody and put your money with them, here's the investment hack. Don't even ask about their track record until you have done due diligence on the deal. So take the due diligence, go through the deal itself, send it to us, help us walk you through the due diligence. Once you have confirmed that this is a good deal, now go and check the track record and do the due diligence on the operator. But the problem is, most people don't really understand how to do the deal themselves, the due diligence, or they don't understand how to do the due diligence on the operator. And if you don't understand those pieces, you just bank on the fact that they've had a good track record. Joe at the hospital said he put money with them and it went great. So I just have this blind trust that everything's going to go well. And that's where people set themselves up for failures, when they just have that blind confidence, because at the heart of it, they just don't truly know how to review the financials, do the due diligence, and do that on their own, or they don't have a team behind them that can walk them through it. So because they don't have the resources to do real due diligence, they just say, I know I want to do better than what the market has been doing for me. The track record looks good. Dr. Joe said this is going to be a good guy. I got to go with what I have and what I know, and I'm just going to trust Dr. Joe that this is going to work. And I throw my money, and then all of a sudden, 3 years down the road, they find out, man, I was misguided here.
Yeah, that can be dangerous. So let's, as people have that conception of passive investing is just hand over your money and sit back and just wait for that return to come. Let's talk about some of that upfront work, that does need to be done. And I want to break this into two pieces. So doing it on the operator, we'll get to that. Let's talk about the deal first, because you mentioned a second ago, don't even ask somebody's track record when you're getting into an investment opportunity. Look at the deal first. So in the intro, I had mentioned that upfront work: research, due diligence, and strategy. Let's think about those three things when looking at the deal first, and then we'll look at research, due diligence, and strategy of the operator here shortly.
Yeah, so we have a episode for Wealth Wednesday we're going to be recording about research and reasoning. So I'll bring it up right now real quick. So the first thing is you have to have the research, which means you have to have the knowledge. If you don't have the knowledge, that's a piece of research where you go and find the knowledge. You have to build that bank in your brain to understand, what am I even looking at? So when you look at documents and it says the exit cap rate is going to be a 4.5, if you don't know what that means, you have to go do the research to first understand, what the heck are they talking about? I need this knowledge. Or you have to have a team of people, somebody you can call on. We talked about building your power team in one of the Wealth Wednesdays. This would be kind of that investment advisor who can help break this down and walk you through so you can build that. Once you have that research piece done, where when you read the financials, you at least know the terms. You know what you're reading. You know what it says. The next step of that is the reasoning piece. Reasoning is built with experience. This is like when people go to medical school. That's the research part. They build a bank of knowledge in their brain. Reasoning is the residency part. Now we're going to be applying this knowledge, and we're learning based on experience of, where does this knowledge fit in? When is it useful? When is it not? When do I reach for that bank of knowledge and apply it? So now when we're going through and we're reading these financials, something like a cap rate, I don't know what a cap rate is. I need to research. But now when we're in the reasoning point of this, I look at the cap rate and it says 4.5. But I know that the Fed is raising rates, which means cap rates are probably going to rise, and a 4.5 cap rate is likely going to be hard in the future. This is reasoning now. So I already know what it is, but also I understand how it applies, and I understand how to take multiple pieces and apply it to this specific parameter. And I say, I don't know if that is a legit cap rate that they're basing this future exit on. I think the cap rate might be higher, which means the value will be less. I'm starting to use my reasoning skills to say, I've seen this before. Something feels off here. So that is the second piece of the puzzle. And when you start to gain kind of that next level. And then the third piece, and when you're doing due diligence on the deal, is what you brought up, is the strategy. How does this fit my strategy? Is this going to get me closer or further to my goals? That's what happens all the time. We'll say, Dr. Joe, this was a great investment. He did this. Well, if my life goals are different than Dr. Joe's life goals, it doesn't matter if that is a great investment for him. I need to know, does this investment fit my strategy? What I'm trying to do? Am I trying to reduce my taxes? Am I trying to swing for the fences because I need big chunks of money? Take it back a step. If you want to invest for cash flow, which everybody should, that's the whole point of why wait for retirement. You need cash flowing assets to buy your time back today. But in order to have cash flowing assets, you need chunks of money to put into that. So sometimes the strategy up front is big chunks of money in which then you can invest into cash flow. Well, if Dr. Joe is at a point of cash flow, but you don't have chunks of money like he does, you might be at the strategy point when you need chunks of money, and this investment doesn't fit that. Or totally vice versa. Maybe you have a lot of money and your goal now is to preserve it and start putting it into cash flowing assets. But Dr. Joe brought you an investment that is for a big chunk of money. It's a swing for the fences home run type of deal. And that's just not where you're at in your strategy. So that's really what we're talking about. I know it's a long-winded answer, but that is what the due diligence is first can I read these financial reports? And we call them offering memorandums when somebody has an investment. Can I read this and do I know what this all means? Do I understand these terms? If not, I need to go do the research to know what the heck I'm even reading. Now, the next stage, I know what I'm reading. How can I apply my experience, past investments, past understanding what other people have done? How can I reason to know, am I being told the truth or is something off here? And now, if everything is lining up, this is likely a good investment. Does this investment actually fit my wealth plan? Does this get me closer to my personal goals? Because it could be the best investment. You could go through all of that and find out it just doesn't meet my goals of where I'm going. My strategy for where I'm going is different. This could be a great investment for Nate, but it's not a great investment for Mike, or vice versa. So once you go through those three parts, if it is a check, 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 then you know, okay, now let's go on to the management team and do the due diligence on the operator to make sure this is actually going to be somebody who can perform on this investment. Because even the perfect investment with a poor operator makes it a bad investment. That's just going to happen time and time again. I am super excited to introduce to you the Doctors and Dollars 5-Day Financial Challenge. I'm Mike Neubauer, I'm CEO of Grand Vision Companies, and I'm the one that you see on the Wealth Wednesday and Daily Dollar episodes with Nate. So Nate and I are partnering again to do something even more exciting, which is the 5-Day Challenge. We're taking the best of all of our episodes, all of our expertise and knowledge, and we're condensing it into an impactful and purposeful 5-day presentation, 1 hour per day, for 5 days to give you everything you need to build that foundation for your financial future. So if you're looking to gain the pieces, you want those puzzle pieces and find out how they fit in your financial plan, head over to the Doctors and Dollars website, join us on the 5-day challenge. We're putting it together for free, so you got nothing to lose. We look forward to seeing you on the inside.
Absolutely. That was beautiful insight. I like how you broke down all three parts of that, the research, the reasoning, and the strategy. I also like that you brought up the past Wealth Wednesday episode that we did around those things and the strategy and making sure that it fits for yours, especially when you have a power team, right? There could be folks listening that are like, I don't really want to do the research. I don't want to understand what a 4.5 cap rate is. I don't need that. But if they have a power team, a strong investment advisor, an attorney who's looked through the deal and says, yep, this is, your exit is okay, or this is structured, favorable to all parties like it should be. Having that power team is super important as well for those that not only want to passive invest, but like truly just, they don't want to fill their brain with all of that information, right? They don't want to spend time doing the research, using the reasoning from their research to then make some decisions. If you have a strong power team, if you have that great investment advisor, you have a tax strategist in there that shows, okay, if this is part of the strategy that we think is a good fit, here's how it's going to impact you from a tax standpoint. That helps you then kind of check that box to say, this is a good deal based on X, Y, and Z, and I have my power team that's solidified that for me. Then moving on to the due diligence of the operator makes that much better. Like you just have a better feeling in your stomach of, everything that I feel about this deal or what I've heard about this deal, has been confirmed by my team. I'm ready to do the due diligence on the operator. So I think you made some fantastic points there.
And like we talked about in that episode, that episode's like an hour long, so much more detail on who that power team is. But each of those pieces of the power team, that can be you. You can wear that hat. But if you don't want to wear that hat, or you don't have the time to wear that hat, or it just doesn't interest you, you start reading about cap rates and you realize, I hate this. I would rather watch Netflix. This sucks. That means you need to find somebody else then to be that person. And then sometimes the exact opposite. Sometimes you have that person, and as you learn from that person that you rely on, that's, let's say, your investment advisor, your tax strategist, whatever the case may be, as you start to gain some of that knowledge, maybe it does pique your interest. And now you start to say, man, I actually do enjoy learning about this. Now I'm going to take a more active approach. Or also, maybe you start buying your time back and you used to work 50 hours a week. We have somebody in the family office, one of the physicians, perfect example. He went back to school to get a finance degree. He obviously loves it. He enjoys it, but he also has a full-time job. So that interest is there, but the time freedom to explore that interest is not quite there yet. But as the investments start paying off and that cash flow starts replacing the earned income, he's buying his time back. So he's relying on investment advisors today, but in the future, as he buys his time back, he really desires to be that DIY and learn it for himself. So that's a perfect example, is it can go both ways, but you do need somebody who knows when they read and do the due diligence on the deal, either you have to know it or you have to rely on somebody else, and that can change over time. But that is very important that you have to cover that piece no matter what, whether it's somebody else or whether it's you, that piece has to be covered.
Absolutely. And that's what I love about the family office. I mean, you and I spend our time being the investment advisor, being the tax strategist for many different physicians that have different goals and different strategies that they want to implement. You know, the example you gave of the DIYer, like we're just kind of there as the double check, just kind of, he does all of his own research and due diligence, and then we're just kind of there to, put a blessing on it, versus other people who are truly passive, don't want to learn everything. And they just say, hey, here's the deal that came across my table. What do you guys think of it? Is this a good deal? And we help them kind of go through the whole process that we just talked about. So there are people out there like that that can be that kind of guiding hand for you to get to that deal. We've looked over the deal. We've done the due diligence. We've done the research, the reasoning. We've looked at the strategy. Now we want to look at the operator with those same facets, right? We want to do some research. We want to look at the due diligence, and we want to understand the strategy of this operator. Talk me through that.
Yeah, so there's actually a YouTube video. You can Google my name, and I did it with an attorney because I think this is the most important thing. He's not on our team, but he is on the power team of many other investors out there. But he basically is doing that due diligence for them. And really, we did an episode on the red flags of the operator. So that's a much more detailed approach. I think his name was Ronald Rohde, Rohde. But you can check out that one of the red flags because it's a more in-depth discussion, just like we just talked about the power team, specifically on due diligence of the operator. But really, you're looking for red flags of the operator. And this is going to be a lot of like gut check of just human behavior and understanding. So of course, there's always just kind of that basic understanding of like too good to be true, right? When somebody's selling you something that seems too good to be true, sometimes it is. So you just want to ask questions. And this is what I always say when you're doing due diligence on an operator. I always prefer a Zoom call. I don't want an audio call because there's so much communication that comes via body language. So what I like to do is just set up difficult questions that they don't have a script for. And it may be off topic of the call, but I want to hit them with questions that catch them off guard. And I want to see, how do they respond? Do they have confidence? Do they naturally take that question and they're relaxed when I ask them that? Or do they tense up and they're caught off guard because you just put them off script of how they're supposed to sell this deal? And a lot of that is just simply because somebody who says they have experience and they walk me through deals, if I ask them a question about a past deal or I ask them a scenario, man, it sounds like you've done a lot of deals. Tell me, have you ever run across this in a deal? And it's something that likely they have, or even like they would be able to consider. If they have that experience, they will be able to very naturally and confidently say, yeah, you know what? We have ran across that in the past. Here's how we handled it. We hate when that pops up, but here's what we do to keep that in place. Something as simple as, here's a great question that I ask a lot, that's just super simple, and somebody who is very good has already thought of this. But I'll say, hey, this sounds like a great deal. I have total confidence in you. Let's say that you're not around. I put my money with you. You get in an accident 3 days later. What does the succession plan look like? What happens the next day when tenants start calling, but you're not around? What is the plan in place for my investment and my money if that happens? And they normally will be like, oh, I never thought about that. And that is a huge red flag to say, that's just not quite a professional level. You may be good at what you do, but as far as taking other people's money, these are the types of planning that now is that next level of taking other people's money and doing well with it. You have to think beyond what you're capable of. You have to think, what if I'm not around? So that's a great question that I like to ask. That really is something that isn't part of the due diligence. It's not part of like the offering memorandum. They don't put in there, our succession plan also is this. They never talk about it. So when I get a Zoom call and I can build them up and say, listen, I trust you. You seem great. But what if it's not you? Then what? Who am I left with? Who's in charge of this thing? What if the next guy, I don't think he's going to be a good fit? What if I don't trust him and believe he has the experience? How does it work in that scenario? That is a perfect question that really throws them off topic and gives you an insight into their brain And then by default, the answer that comes back always just naturally leads to more questions. Now you can kind of start walking down that path. And people can sell you on their track record so easily. That's the downfall of asking those obvious questions, right? Like somebody already has a script for all of these obvious questions. What kind of returns have you gotten in the past? Oh, we've gotten blah, blah, blah. Oh, have you done this multiple times before? Yes, our track record consists of this. Like, it's like talking to a robot and you're not going to get real answers. So all you do is sit down on a Zoom call, you ask a couple prying questions, you really kind of poke the bear and see how they handle it and what the response is. And that'll tell you up front, who am I dealing with here? Because the reality is, in all times when you're doing due diligence on an operator, really what you are asking and what you have to understand is, am I dealing with a good human being? They have a good moral compass. And am I dealing with somebody who can handle adversity and obstacles well? Because no matter how good the track record was in the past, it doesn't change the fact that obstacles may pop up in the future. And I just need to know, can this person handle obstacles and challenges as they come up? Or are they only good when times are good? And I need to prod and point at questions to find out, how do they respond under pressure? And I need to ask questions that put them under pressure and put them on the spot, because that gives me an insight in how do they handle those types of situations.
Absolutely. Earlier you said you might do your front end due diligence on the deal, and it's a great deal. But the operator, then there's some red flags. There's some things that make you a little uneasy about it. How much weight does having a strong operator carry in the overall process for someone to walk away what looks like a good deal? Financially, it is a good deal, but to walk away from it because of the operator, how much weight is carried there?
Yeah, I'll tell you, for most people listening to this that are not professional investors like us, it carries a ton of weight. I mean, 99% of the weight. If it's a slam dunk deal, but a poor operator, you have to walk away. It's just too much opportunity for mistakes to be made that will crush a deal. Too much mistakes for, honestly, just like walking the line of fraud. Like, will somebody make the right choice when push comes to shove? And there's just too much opportunity for error there if it's a bad operator. And if you're not a professional investor, you don't know how to step in and take that deal over to bring it to the finish line if that operator does poorly. And that's why for most people, the operator is going to be 100% of the deal. For us, the operator is very important, but as long as I can get what I need in the operating agreement or the deal, then I'm willing to roll the dice on a poor operator a little bit more. And what I mean by that is, as long as, say, we have voting right, or we have the ability to step in as manager without, say, court approval, or without jumping through all these hoops. If I see that things don't go as planned and we say, here's the parameters, you have to meet these parameters. If you don't, I step in as manager and I start calling the shots. If I can get that type of security in the deal, then I'm willing to move forward with it. But if we don't have that security, or if I'm not confident in myself to be able to run that type of a deal, then the operator is a do or die. If I don't have full faith in that person, the deal is just not going to work.
Cool. And then let's flip it the other way. Now we're talking about potential investors who approach or are met by an operator who is great moral compass, has a strong track record, is able to handle adversity well, but the deal they bring is not so great. There's maybe a few holes. The return isn't great. You're looking at it thinking, okay, this thing should return this, and it's a little bit less. Is that a stronger position to be in, to say, hey, I think I'm going to move forward with this because of the operator? If it does carry 99% of the weight, I just have confidence in them that they could take what looks like maybe a single, if we want to use a baseball analogy. I think they're such a strong operator. I think this deal is a single, but they might be able to turn it into a double.
Yeah. So the scenario that presents itself is a potential, but it's actually unlikely. So the way that scenario plays out, if you have a good operator, but this is also why you need to identify the deal first and the shortcomings, because if you have a good operator, this is how that plays out. You identify, let's say, 3 points of the deal that you feel like it just isn't the deal that I expected. When you talk to that operator, you're going to discuss those 3 points. And one of two things is going to happen. Either you bring up that point and say, this is going to return a little bit less. Why are we here? And that operator is going to say, well, because of this, and here's how we're going to combat that, and here's what we're going to do. And you're going to find out, okay, my assumption is actually not correct. They already had a plan for that. Or it's going to go the other way, and that operator is going to say, you know what, I never really considered that. I kind of, not to say missed that, but that didn't carry a lot of weight. But now that you bring it up, let's dive into that. And maybe he's going to go renegotiate the deal. Or maybe they're going to go to the bank and say, we need to adjust these terms a little because we didn't identify this until one of the investors brought it up. We do need to take a look at this. So a good operator is going to take that as constructive feedback, call it constructive criticism, and they're going to say, I'm a good operator. I do not want any holes in this deal. So if you identified a hole, let's go ahead and discuss it. The only time it plays out differently is if we get to the strategy standpoint and it just doesn't fit your strategy. And the operator is going to say, I mean, I understand what you're saying, but the purpose of this investment is this. If that purpose doesn't fit your strategy, it's just not a good investment. It's not a hole. It just doesn't fit your strategy.
Fantastic insight there. Not the answer I thought you were going to give. And so I think that the points that you made there were very strong, and that a good operator, if you've already believed that they're a good operator, are going to have a solution for some of those pain points or for some of those pieces of the deal that maybe didn't stand out to them, or you didn't feel like it did. It stood out to you. They may have that resolved already, and that just solidifies the deal then for you.
Let me give you an example real quick. We were just talking about that. So the due diligence of the operator. So in reality, the action plan, how this works and why you do the deal before you even consider who the operator is, which is so hard, right? Like, people have Facebook profiles and all this stuff. So when you see a deal, it's just so much easier to just look somebody up, go check them out on Facebook, start to get a feel for the human. That's just easier research than it is to dive into a 50-page document of an offering memorandum. And that's why we always kind of default to the operator first. But the action plan, you do the deal first, you identify these holes. You find out, where does this deal fall short, in my opinion? And now when you do that due diligence with the operator, you jump on a Zoom call with them. Now you ask them those hard questions. Hey, I trust you. What happens here? You know, if you were to pass away, blah, blah, blah. You get that response. Now your gut says yes or no. If the gut says no, you say, you know what? I don't think it's going to work. I appreciate your time. You're done. But if your gut says yes, this is a good person to operate this deal, now you already have the data points in which you feel the deal falls short. So now the conversation transitions into that. That's a great plan, you know, blah, blah. I really appreciate you sharing that. Now, I'd like to talk about a couple parts of the deal. When I was looking at it, you know, I saw this and this. What are your thoughts on this? It feels like that cap rate on the exit is a little short. Why do you think you can hit a 4.5 cap? I feel like more we're going to be pushing 5 to 6 cap down the road. Why do you think you can hit a 4.5 cap? So now I already have the data points. So when I jump on the call with that operator, I already know if my gut says yes, now I know how to take that conversation and start actually discussing valid points of the deal. And by the end of this 1 hour conversation, say on a Zoom call, I've already got my gut, yes or no with this person. And now I have real objective data. Does this person have a plan for the holes that I've identified? And now the deal is pretty much, now we have the information that we need. The only question now is, let's talk with the tax strategist to make sure this plan fits with my wealth plan. This isn't going to, you know, cost me a ton in taxes that I didn't see coming. But otherwise, I'm ready to rock and roll and move forward now. That's why you do the deal first. So when you get on the Zoom call with the operator, you're not wasting your time, which is the most valuable asset you have, and you're not wasting their time. You're actually getting to the point, and at the end of that conversation, you feel like, yes, I can make a decision on whether I'm going to move forward based on whether this fits my strategy.
So you've made the decision. You're going to be moving forward. You're ready to rock and roll. You've confirmed with the power team. Everything looks great. When is passive investing hands off? Is it at that point when the money moves over to the operator, and or is there still some? You don't want to be kind of that helicopter investor, right? We've encountered a few of those in our days that just want to know every aspect, and they want to be a part of it, and they want to give their 2 cents on certain deals. Is it at any point, and when I say it, I mean passive investing, is it ever hands off? At what point in the process is it?
Yeah, this is pretty much at the point when it becomes hands off. So now most likely, most investments will give you about a quarterly report. So every quarter you do want to review that report. But all of that work in passive investing is really upfront. You know, 90% of that work is upfront. After that, it's just going to be quarterly reports, checking them out, making sure nothing's off, making sure everything seems in line with what you expected. And then you're going to get an annual tax return. So at that point, it's really more of, your personal financial situation, but you're going to take that K1 and you're going to go with the tax strategist and your CPA to make sure that it all is going on your tax return in the right way. That, for instance, a K1 didn't have the wrong box checked. And now you have to call that operator and say, hey, on that K1, you checked this box, but I think it should have been this one. So that's going to be a once a year type thing. And then a quarterly report reviewing those just to make sure everything makes sense. But really, after that upfront work, it really just becomes kind of a maintenance routine at that point, just to double check and make sure things are going as you expected. But all of that work, call it 90 to 95% of that work is before you say yes and write the check.
My last question for you before we get some final thoughts, and I don't mean to put you on the spot here, I just thought of it, but I think it's really important for the listeners who are probably thinking about it. We've been using the scenario of multifamily real estate or real estate in general throughout this conversation. What are some other passive investment strategies that could come up? That's kind of part A. Part B then, should there be the same research, due diligence, and strategy with these different passive investments that are not real estate? So give me a couple examples of non-real estate passive investments, and should the same process and procedure be handled both for the deal and with the operator for these other strategies?
Yeah, 100%. So everything is going to be private real estate or private business. That's where investments go. That's going to be your best strategy. Almost always. It's very difficult to find something that's not a better strategy than the private business, private real estate. So we'll switch to private business. This is the number one place that physicians have a leg up in investing, is a private practice. We talk about it all the time. If you invest in a private practice, then you understand behind the scenes. You can talk that lingo. You know the medical terms. You know more about medicine than the average Joe on the street. So you have a leg up in doing that due diligence. But where this due diligence falls short and where people will make a mistake in a private business investment, let's talk about a private practice. A doctor, they want to start a private practice. Let's call it like a ENT. You had that one doctor on and he talked about how the equipment for ENT is just so expensive. The upfront costs are just so much. And this physician doesn't have the funds to really build this out and get all that equipment. So they're looking for investors. You decide to be an investor. You base your decision on knowing this is a great doctor. You know his skills. You know that she can operate and do these procedures and people love her as a doctor, or that he, was top of his class in med school and he's just a genius at ENT, whatever the case may be. You trust them as a medical professional because that's where you base the most importance. But when you dive into it, they don't have any business background. They've never actually run a practice. They don't have a mentor that has run a practice. They don't know how to do marketing. They don't know how to run the back end of what you are actually putting your money into. So although they may be a great employee as a physician, they may not be a great business operator. And a lot of times people can get swayed on the trust of, this is a great doctor. This person's great at what they do. It could be a mechanic. This is an amazing mechanic. They can fix anything. They're so good. They may be the worst business operator that has ever been. And that is where people get distracted and they drop the ball in that due diligence. Is they assume that the skill at the profession, at their talent, whatever it is, translates to their ability to operate a business. And that could not be further from the truth. And that's where people make mistakes in passive investments for business. So when you bring up the business, that's a very difficult one because people can almost get swayed by the fact that this person is very good at what they do. And you kind of forget to dive deeper to say, but are they good at running a business?
Yeah, I kind of teed that up for you because that's exactly where I wanted you to go is to talk about the difficulty. I mentioned it at the trust. I called it, or at the beginning, I called it trust. You called it confidence. I think the both adjectives kind of, align here as well, that you may look at this person and have all the trust and all the confidence in them. And in your heart, it makes it easy to invest into their business, when really on the business side of things, they just don't have the acumen to be able to handle that. They may not have the team behind them, right? They might be great when they open that business. They might be great patient to doctor right on the front lines, but the back end financials, the marketing, all of the things that go into growing the business and honestly providing a return on your investment, they may not be very good at that, and they may not have a team to be able to support that. Do you feel then in that sense that it's almost important to do your due diligence on the operator first? In this case, maybe a physician opening a practice. Do your due diligence on them first, then look at the business that they're going to be opening to make sure everything's clear there? Or is it still deal first, then operator?
You just have to have a process always. So we always just stick with deal first, then operator. You don't want to get distracted from your process. That's how things get dropped and fall through the cracks. So you always want to do deal first and just make it your standard practice. I always look at the deal first, then I consider the operator. And you know very quickly whether the operator is going to be able to run with this. So when you do the deal, the beauty of it is doing the deal first as well. It's really just practice. So you have nothing to lose. Even if you spend 10 hours diving into a deal to understand it, and then you get to the operator and find out this is garbage, this isn't going to work. You still basically just practice your skill of analyzing a deal for 10 hours. You didn't lose anything, even though you're not moving forward with an investment. So you always want to have that same process. But the most important part of having that deal analyzation first is now you can actually truly do the due diligence on the operator, because you have specific questions that are deal related that you can now ask the operator and see how do they respond. Are they prepared? That's where you're going to find out, does this person actually know how to run a business? If you don't do the deal first, you don't know how to ask deal specific questions. Therefore, you can't do due diligence on their business acumen. You're going to be stuck asking questions about, for instance, medical, or you're going to say like, hey, how many cars have you worked on? Have you started working on Teslas? You're going to ask questions about their skill level in their craft, not their ability to run a business and run that deal.
Very good insight. All right, final thoughts on passive investing. The myth that passive investing is just hand some money over, sit back and wait, and reap the rewards of that return. Just some final quick thoughts on that.
Final thoughts. The word passive obviously is confusing because people think it's just super easy, but they miss the fact that it just means it's active up front, passive down the road. So you just can't get confused by the term, calling it passive investment and thinking that it means no work. And the problem is that most of the time, these investments, nobody says like, oh man, these investments, I pretty much had an idea that it's going to be terrible and I was going to lose my money. Most of the time, it's just that the gambling, the bet paid off multiple times in a row. Therefore, there was a false confidence built in the gambling of that investment. So I didn't do due diligence. I didn't do the work. But it turned out fine. And then boom, crash and burn. So maybe I put in 50,000 and I just got lucky. I flipped heads or tails. I thought it'd be tails. It landed tails. It was 50,000. I do it again now and I do 200,000 because I have confidence from that first deal. And now I do 200,000. Man, it worked out pretty well again. Now I'm going to do it a third time, but I have two opportunities that turned out to give me false confidence. I go do a third time. Now I'm going 500,000 in. I feel good about this. This is the one that crashes and burns. And you think, how did they screw this up? But the reality is you just got lucky the first two times without doing the due diligence. It was bound to happen. This false confidence just kept leading you down this false path that passive investment means no work. And if you would have done the due diligence up front, you either would have identified this person isn't capable or this deal isn't good, or at minimum, you would have identified, even though the first two deals went well, this third deal has holes in it because I do a process of due diligence for every deal, no matter how the track record worked in the past. And I would have identified, even though deals 1 and 2 were good, deal 3 has holes in it and this person just isn't ready to hit this level, or this deal just has holes in it that they missed and they can't overcome. I'm not going to do deal 3, even though deal 1 and 2 went well. So it's that false confidence that leads people to believe this is good. And the worst thing, the thing that like crushes my soul, is when that false confidence leads people to start telling others. And they say, this worked great for me. I promise it's going to be good. And all of a sudden now they have 5 friends who crashed and burned on this deal 3. And now they feel terrible because they were really just had false confidence and missed it. They told their friends. Now their friends are mad at them. And worse yet, now their friends think they have a false opposite. Now the friends think you should never invest because it always crashes and burns. And it's like, no, this is all just based on the fact that there was no solid foundation of a due diligence process. Everybody in this scenario assumed passive investing means just put your money there and it's super easy. You don't have to do anything. So now you have a terrible situation in which all these people financially are going to make poor choices in the future, whether it be out of scarcity or whether it be out of luck. And really, it just leads to this domino effect of making people just put money in the 401k, wait for retirement, and say, I told you this doesn't work. This always happens this way. And really, that's just not the case. It's just a lack of due diligence and doing the proper work up front to make wise investment choices.
That's fantastic clarification, because our whole conversation has kind of been on the pretense of here's the due diligence process for that first deal that you come across. But I appreciate you clarifying, like, this process is done every single deal so that it's not win, 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 loss. Oh, why was there this loss? Like, it just must have been, a fluke. It's like, well, no, you got to do your due diligence every time. The operator can change over time. The strategy might not meet what you're going for, or it was just a bad deal. And if you didn't do your due diligence and you just blindly trusted the person who's been successful for you the first couple times, it can fall through. Even starting quarterbacks are evaluated every single week of the football season. So you always have to keep your pulse on every deal that comes across and understand that as long as you follow your process, you are minimizing the risk of potential loss, and you're improving, the opportunity of a successful game. So I appreciate you taking some time out again. We'll do it one more.
Yeah. One more thing to clarify real quick, because we've talked to some of these physicians because they have that fear, right? I have so-and-so who lost 500,000. I saw so-and-so, they put 400,000 into a deal and lost it. And every time I just ask a few questions about that deal, and I can identify within 2 questions why that deal went bad. I can say, well, this is a whole new asset class. Just because they did apartments for 5 years and crushed it, buying a skyscraper in downtown Cleveland, that's a whole different level. If you've never done that before, that is not going to be the same as doing some apartments, somewhere else. And I can identify when they say we lost money, I say, tell me a little bit about it. They start talking. I'm like, well, right there, So the good thing is the due diligence, when you do it, it's usually pretty obvious. You can usually tell pretty quick. It's not like there's all these hidden factors that you have to uncover. Usually it's common sense type of stuff when you're doing the due diligence. So that's the one thing I want to kind of clarify too as a final thought is don't feel like this due diligence is so unbelievably difficult and there's all these little hidden sneaky things that you have to catch. Do you have to have the research? Do you have to have the knowledge and then be able to apply reasoning? Yes. Or if you don't have that, do you have to have somebody you can rely on that can do this well? Yes. But anybody, once they have that skill level, these little markers that identify themselves as this isn't a good deal, they're usually pretty obvious. They're usually not buried deep and hidden below all kinds of different things. They usually jump out right away. So when we look at a deal, within 10, 20 minutes, you have a pretty good hunch of, man, there's a lot of red flags here. I don't know about this. When I jump on a Zoom call with an operator, within 10 minutes, you pretty much have a feeling of yes or no. So it's not like this crazy in-depth thing, like you got to be Sherlock Holmes identifying that one key piece and it's going to take 100 hours to go through this. It's usually pretty obvious stuff. It usually isn't a matter of I missed this in due diligence. It's usually as simple as I just didn't do any due diligence. I didn't miss anything in due diligence. I just skipped that part completely, and that's what I missed.
Awesome final thoughts. I'm glad you threw that last bit of clarification in there. That really caps off another great episode. We will continue debunking these financial myths for physicians. We'll be back with another Daily Dollar soon. See you, buddy.
See you, man.